Thank you for joining us today for the fourth quarter FY18 earnings conference call of the new merged Dish TV India Limited. To discuss the results and performance, joining me today, as always, is Mr. Jawahar Goel, the Chairman and Managing Director of Dish TV India Limited. We also have Mr. Anil Dua, the Group Chief Executive Officer of the company, and Mr. Rajiv Dalmia, the Chief Financial Officer. We will start with a brief statement from Mr. Anil Dua, and he will then open the discussion for questions and answers. Just quickly, I would like to remind everybody that anything that we say during this call that refers to our outlook for the future is a forward-looking statement that must be taken in the context of the risks that we face. I would now request Mr. Dua to address the participants.
Thank you, Tarun. Good evening, ladies and gentlemen, and thank you for joining us today. It's my pleasure to report the first set of merged financials of Dish TV India Limited. I'm happy to share that merger integration across functions has been successfully completed, and new roles, responsibilities, and key deliverables have been well received by our teams. I see a new sense of passion and urgency all around in the company, and believe that we have everything we need to surge ahead. Revival in rural demand, prospects of a good monsoon, and an increase in infrastructure spending is likely to drive a broad growth recovery going forward. The merged company subscriber base is a fair mix of urban, semi-urban, and rural subscribers that would enable it to benefit from increased discretionary spending across categories. A healthier urban mix would be beneficial to the revenue pool, while at the same time, a stable, paying rural base would help buffer the platform from alternate technologies. There's a significant growth potential both in the short term and the long term when it comes to acquiring new subscribers. While in the short term, digitization will continue to feed subscriber additions, government schemes focused on bridging the urban-rural divide will create demand for new televisions and pay TV connections in the years to come. Three well-recognized and powerful brands, Dish TV, D2H, and Zing, are now being marketed under the Dish TV India Limited umbrella, with each being favorably positioned in its key target markets. Identifying the strengths of each brand, the company has been targeting profitable growth while maintaining healthy competition and encouraging synergy in back-end operations. Separate sales teams with uniform structures are both complementing as well as productively competing with each other in the market. On the customer service front, the company aims to build a faster, better, and efficient service model that no other DTH player can match. On the regulatory front, the recent ruling by the Honorable Madras High Court on the TRAI Tariff and Interconnection Orders 2017 should go a long way in ensuring a level playing field in the television distribution space in India. Now coming to the financials, the fourth quarter fiscal 2018 consolidated subscription revenues and operating revenues stood at rupees 13,771 million and rupees 15,324 million respectively. Adjusted EBITDA for the quarter stood at rupees 4,606 million, resulting in an adjusted EBITDA margin of 30.1%. Presuming that the financials for fiscal 2018 had represented 12 months each of Dish TV India Limited and Videocon D2H Limited, operating revenues of the company would have been rupees 62,377 million and corresponding adjusted EBITDA would have been rupees 19,690 million with an adjusted EBITDA margin of 31.6%. We are confident that fiscal 2019 would be a year of exceptional growth for Dish TV India Limited. A fresh campaign and brand tagline is only the beginning of what will be a transformative year for the company. With that, I'd like to open the floor for the Q&A session. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, thanks for the opportunity. My first question is on the sales team. You mentioned a separate sales team with uniform structures, both complementing as well as competing with each other. So if you could elaborate how you are able to get the full efficiency from this if they are competing and also complementing, and how both are possible, if you could take us through that. And do you see this, even after 1 year, this kind of sales structure still remaining?
Okay. Yeah, thank you, Avnish. I think, yes, that is what we are attempting. Right from day one, we've been saying that it's our intention to see that in this merger, 1 plus 1 becomes 3. Because if we are not careful, there's always a possibility of 1 plus 1 going less than 2. And one of the key things we've thought towards that is that we should maintain 2 brands and 2 sales teams to healthily compete and to further increase our share of the dealer space as well as the customer space. So they will compete with each other in the sense that they will continue going as 2 different brands as they have always gone. And they will compete for dealers' funds and dealer shelf space and the channel share and customer share as they have been competing. They will complement each other because we'll pick up the best practices from both the platforms. And we will ensure that they are equally empowered, equally enabled in terms of MIS available to them, in terms of resources available to them, and in terms of all the policy uniformity that can be implemented across the 2 platforms. We feel that this will give the best combination of back-end complementarity as well as front-end competition, healthy competition that we've spoken about. Also, because there are different regions of strength of the 2 brands, what this will also imply that we'll be able to regionally offer a better kind of sales mix in the marketplace. Wherever D2H is strong, we'll be able to ensure that we take that strength further and vice versa for Dish TV. So that's what we mean in terms of competing and complementarity. In terms of whether it will continue even after 1 year, we see that in foreseeable future, the 2 brands will continue. Eventually, there may be possibilities which certainly is not within 1 year or within foreseeable future. But yes, we cannot rule out eventual merger after a few years.
So one follow-up here, because foreseeable future both will coexist. In a lot of markets, both brands do compete. How do you ensure there is no price cutting? Because I think in terms of pricing, in terms of most other parameters, I think you will maintain similar. So then in the same market, when they compete, don't you see some irrational behavior by the team on ground?
So sufficient checks and balances will be put in place to see that such irrational behavior can be controlled. But you see, at some level, these 2 systems converge. So while at the front-end sales people level and the first supervisory level, these 2 systems will operate independently. But above the first supervisory level, we will have, a convergence. So let's say each circle has a circle head who has a cluster head for Dish TV along with the sales team of Dish TV as one leg, and cluster head of D2H along with the sales team of D2H as the other leg. So the circle head will bring in the necessary sanity to the whole system to ensure that there is no price cutting or incorrect practices that come into the system.
So my second and last question is on a la carte. You have mentioned 2 million people have taken a la carte and this has led to incremental revenue. I thought because in a la carte customer will choose and he watches very select number of channels, the revenue could have come down. So if you could explain that bit, how incremental revenues have come. Second, on the Chennai court ruling for fresh developments, but tariff order, we have seen a lot of false start and delays. What's your take on it post the Chennai ruling?
So I'll take the first one, which is on a la carte or Mera Apna Pack on Dish TV platform and Mera Wala Pack on D2H platform. Yes, we've aggressively acquired, new channel sales under this. And there is certainly a risk, as you said, of revenue coming down. But please turn it on its head. Revenue in any case is coming down. As you know, that there's a wide-scale down trading which has been happening in the market over the last 2 years. Now, people who have come down, we want to recover some revenue from them because, let's say, if they were paying 299 rupees earlier and some of them are paying 199 rupees, Mera Apna Pack or Mera Wala Pack or a la carte pack is an opportunity for us to get back 20 rupees, 30 rupees, 50 rupees from them. So that is what this initiative has been trying to do. On the Chennai court tariff order, I'll ask Joharji to respond, please.
I think it's only 10 days now. The court has granted 2 weeks time for to put it under suspension. That is, if anybody is aggrieved, they can go to Supreme Court. So far, TRI has only filed a caveat, and we have not seen any party going in the Supreme Court. So let's see by Monday what happens.
Okay, sir. That's all from my side. Thanks a lot.
Thank you. The next question is from the line of Vivekanand Subaraman from Ambit Capital. Please go ahead.
Hi. Couple of questions. One, can you please get the housekeeping questions out of the way, the revenue split, gross debt levels, net debt levels, regulatory dues, and also commentary on the accounting policy with respect to lease rental, license fee provisions, regulatory dues. That's question one. And secondly, on revenue growth, you mentioned that you intend to grow faster than the industry. What is your turnaround plan here? Because we've seen that in the last 3-4 years, our revenue market share has dipped because of our presence in, say, the rural markets and also free dish impacting us a lot more than other players. What gives you the confidence that now, after the merger, you will be able to grow faster, grow revenue faster than the industry? If you could extend your revenue argument to the long-term plan, because if I look at Airtel, DTH, and Tata Sky, both of them have broadband operations. Tata Sky is piloting it. Airtel has a home broadband business already. So you have outlined that you are going to launch integrated OTT services. But do customers really need one more app to watch content, or is there any thought process with respect to investing in broadband? I'll stop here. Thanks.
Yeah, first housekeeping question. In terms of split for this quarter, the subscription revenue is 1,377 crores. Teleport service is 6 crores. Bandwidth is 51 crores. Sale of customer premises equipment, which is a special item, 42 crores. Advertisement is 20 crores. And lease rental is 35 crores. And total is 1,532. In terms of gross debt, as on date, it is around 2,750 crores. And net debt is 2,200 crores. So 550 crores is the cash that is in the books of the company. In terms of regulatory dues, it is 1,950 without interest. Plus, we need to add interest also to make it the number which is published in the one-pager. What were the other questions after?
I'll take that. Your second question, Vivekanand, was on how the revenue growth will come. I think a couple of points here. One, I have already said that, we do expect the economy to accelerate we expect infrastructure spending and all other measures to translate into, more consumer spending also, and that should give us and, of course, the DTH industry the boost. But secondly, on our platform, with these two platforms coming together, Dish and D2H coming together, we definitely see possibilities in terms of riding on each other's strengths to create some revenue synergies, which will help. And thirdly, if you look at the combination, for example, you spoke about rural market, etc. We have spoken in the past that 75% of Dish numbers come from rural. If you look at the combined platform, we are talking about not 75-25 split now. We're talking of a 65-35 split. So we have a good profile in urban as well as a good concentration in rural. And we think that puts us ideally in, to harness both the ends of the spectrum. And along with several other initiatives that we have in mind, including strengthening our brand, further building on the initiatives we've taken in terms of high definition, in terms of our pay-term sales, in terms of Mera Apna pack that we spoke about. We hope all these will help us build revenue. Your third question was on comparison with Airtel, Tata Sky, our integrated OTT service. Yes, we definitely have plans to be in OTT space. You said, does the market need yet another app? Well, the point is that space may be small today, but it's a growing space. It's a space where at least the upper end of the market is moving. So that needs to be de-risked by all the platforms. That needs to be an area where we need to play in, because ultimately it is the content consumption which we do through our distribution, and therefore it is not an area we can ignore. And that is why we have definitive plans to enter this space and make sure that when this segment becomes big enough, we are already there to take advantage of that.
Right. Thanks for this. Just one follow-up on the OTT side. Do you also intend to invest in wired broadband to connect boxes, or what are your thoughts on two-way connectivity of set-top boxes and on-demand content in set-top boxes? Because you've written a bit on the set-top boxes and how you are becoming more efficient due to the merger. Any thoughts on this?
This is Jawahar here. Mostly we will target the homes who already have a Wi-Fi in the home. So we will not be wiring and creating infrastructure at all. We may tie up with the local service provider as well, because in each vicinity there is a local service provider to facilitate the sales.
Right. Thank you and all the best.
Thank you.
Thank you. In order to ensure that the management is able to address questions from all the participants in the queue, we request you to please limit your questions up to one per participant. If you have a follow-up question, we request you to please rejoin the queue. We move to the next question from the line of Yogesh Girve from B&K Securities. Please go ahead.
Sir, thanks for the opportunity. So my first question is regarding the subscriber additions. So first of all, what has been the additions for the quarter, and what has been the trend which has seen in the recent months? And also if you could give some guidance or expectations pertaining to FY19 in terms of gross or net additions.
Well, I think we are talking about the financial year. We will talk to you on the first quarter result and on the subscriber, what is happening in the current month. And we should also keep in mind that there is a 30 days window of the tariff implementation from the TRAI. So the industry has to work together to achieve the tariff order in place This TV is, as we had said, that we have a 2.2 million subscriber on Mera Apna Pack. This is a precursor of the implementation of the tariff order, which I think we are the only one, I guess, in any of the DPO, including cable or the DTH industry, that who had geared up to sell the pay channel based on the tariff order and the customer demand.
Right. So can you state what has been the subscriber addition during the quarter, in the fourth quarter?
It's been 0.2 million in the quarter 4.
So this is 0.2 million. So this is across both Videocon and Dish TV brands?
This is a net add.
Yeah, these are net add.
Yeah, net add across both the brands, right?
Yes.
Okay, sir. And secondly, regarding just a clarification, so I understand, so there was differences in the accounting as far as the license fees are concerned between Videocon and Dish TV. So our P&L for the 4Q is as per the Dish TV's accounting in terms of the provisioning for the contested amount of license fees?
Yes.
We are done based on Dish TV practice.
Right. And I understand, if I get my understanding right, so Videocon, we will have a similar arrangement regarding the passive infra. So there would be further benefits that would flow in from the first quarter of FY19?
Yeah, it will flow from 1st April 2018. So it will be visible in the first quarter of this year.
Sure, sir. Thanks a lot for this. I will join the queue for questions.
Thank you. The next question is from the line of Rajiv Sharma from HSBC. Please go ahead.
Yeah, thanks a lot. So just a couple of questions from my side. What are your thoughts on the CAPEX guidance, how much you plan to spend over the next few quarters? And second, if you look at the new tariff order and given that content costs go out, the EBITDA per subscriber, improves significantly for DTH. So, there will be some increased cost around, consumer branding. So just want your thoughts and, some color on this as to how do you see this playing? Will it be completely, a 2x increase or it will be increased by 1.3, 1.4 times?
Consumer spend is well within the budget of the company, both the brands. And we don't expect extra spend on this. Number two, your question is on the CAPEX. We estimate that the CAPEX will be around 1,200 crores in the year.
Just a follow-up. So, you think when the content costs go out as per the new tariff order, so the whatever increase in EBITDA per sub that entirely flows through, or there will be, you don't see anticipate any kind of increase there, means lesser EBITDA?
No, we have never said so. We have never said so that the content costs will go away because of the new tariff order. I think new order will come. So we don't know how industries will sit together and how the industry pan out. The industry has been working in a certain fashion, like might is right kind of environment for last 25 years. So it has to gel. We will keep you informed what is happening in at that front.
But overall, you see this tariff order as positive for DTH?
Yes, because we will be allowed to charge for the pipe and for providing free-to-air channel, certain free-to-air channel. And plus for the pay channel, we'll get margins there. Plus, most of the thing is that it will be a non-discriminatory. So, the prices what has been given to a cable operator in say, Chennai, Arasu Cable, the same price will be applicable to us.
Okay, and just a separate question. What are your plans to drive ARPU the next year apart from HD? And what is your HD base now in the combined entity?
So, this will be one major focus area for us in terms of driving ARPU. First of all, we've started that last year and we continue to persist with focusing on quality over quantity. So we are looking at better quality of customers. We're looking at better channels which bring better quality customers. In the traditional channels, we're looking at better controls which bring quality, which lower churn. And we're looking at incentivizing our teams on quality. So that's one thing, which should certainly get more revenue from the same base. Secondly, while you said other than HD, I think HD is going to be one major area that we will drive because it started giving us good dividends, and we will like to build further on it for both the brands, for Dish as well as D2H. The numbers on HD, since you asked, the numbers are in the region of about 3.5 million, both the platforms put together, net base, which is on 60-day basis, which is about 15% of our overall net base.
Okay. That's helpful. Thanks a lot.
Thank you. A reminder to the participants to please limit your questions up to one. Should you have a follow-up question, we request you to please rejoin the queue. We move to the next question from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi, sir. Most of the questions have been answered. Just, on this HD subscriber base that we mentioned, the 2.2 million, a la carte based, the customers who are opting for a la carte channels, does that include HD as well? And is there a, count included in 3.5 million?
Yeah, that's a small percentage. Majority of them are standard definition customers, but there are some who are high definition also. Majority of these 3.5 million are customers who are taking a full-fledged HD offering and not just one or two HD channels.
Sure, that's helpful. Now, secondly, on the subscriber base, now we did mention net subscribers of 23 million versus earlier, cumulative number of around 29-30. So all the cleanup in terms of, the revision of the life that we calculate is all done, and what, numbers are we looking at over there?
So we've gone in line with the industry practice. Earlier we used to take 120 days. Now we've looked at 60 days. So we feel that this is in line with industry practice, and B, a more rational way of accounting for the number of subscribers.
Plus, we have also removed complimentary subscribers, demo subscribers, and lifetime subscribers.
Complementary, demo, and lifetime. Okay. That's helpful. Sir, lastly, on the content cost, if you can share either the H1 numbers, for us after the merger, that is.
I think we can discuss this one-on-one.
Okay, no worries. That's it from my side, sir. Thanks a lot.
Thank you. The next question is from the line of Dipesh Mehta from SBI Cap Securities Limited. Please go ahead.
Yes, sir. Most of the question has been answered. Just two questions.
Excuse me, this is the operator. Mr. Mehta, can you speak closer to the phone, please?
Is it better now?
Better, sir. Thank you.
Yeah. Just want to get sense about what kind of FCF we might have generated during the year, if you can help us with that number. And how you expect, considering the 1,200 crore capex which you indicated for the next year as well, how one should look at gross debt and FCF kind of number entering into 19? And second question is similar about content. Can you help us understand, because one of the synergy benefit which we anticipate was related to content negotiation also. So if you can provide some color about synergy benefits, how we expect it to play out in next couple of years. Thank you.
I think I've already mentioned about the gross debt, which is 2750 crores. And we have 550 crore in the book as cash. So the debt is around 2,200 crores. In terms of free cash flow, because it was a very heavy year in terms of exceptional expenses like one-time merger expenses and development of infra, so it was restricted to around 250 crores. But we have been able to reduce our debt from 2950 to 2750. That means we have paid 200 crores in the last 90 days.
Okay. And second question, if you can address.
In terms of content, we have said that we are not revealing or we are not discussing the content over the telephone, over this call. And synergy, we still stick to the figure of 510 crore, and out of which we can give some kind of split on the call, which will be around 70-75 crore interest, around 110 crore, 120 crore of CapEx, and the balance will be a combination of content, back-end services, administrative expenses, and call center expenses.
Okay. Okay, maybe I can take it offline. Thank you.
Thank you. Next question is from the line of Jay Doshi from Kotak Securities. Please go ahead.
Yeah. Hi, thanks for the opportunity. Just want to understand, how will you continue with the revenue recognition? I believe lease rental revenue recognition was different from Videocon DTH. So are you intending it to align with Dish TV in FY 2019? Or?
No, we will have to follow India's 115, which is different than whatever we have been following so far, both the companies, which is under progress. And our first quarter result will be as per India's 115. We will try to maintain the revenue closer to whatever it is by adjusting or restating the revenue of the past 3-4 years. We are in discussion with the auditor. Otherwise, we have to slightly postpone the activation revenue to the extent of the customer's life.
Sorry, so would you be, so there must be some amount on balance sheet that you amortize on a quarterly basis pertaining to Videocon DTH. So will that be fully amortized in FY 2019 and going forward the entire activation fee will be recognized upfront the way it is done for Dish TV? Is that?
No, as far as D2H is concerned, whatever was previously connected as activation revenue, which needs to be amortized as per the plan of that year, that will continue to follow that. The new revenue which has accrued from 1st April 2018 will be same for Dish TV as well as D2H, and which will be in line with India's 115. Now, there will be some impact of India's 115. We need to postpone some of the revenue, which is not forming part of the upfront cost. That needs to be apportioned over a period of, say, 2 years or 3 years, which we can give you more color maybe in the call of the first quarter this year.
Understood. Now, second question is this 132 crore interest cost in this quarter. How much of that is actually interest outgo and what component is pertaining to provisioning related to prior period liabilities, license fee?
No, license fee we are doing like any other year, any other quarter. In terms of 132, we have paid some of the interest costs pertaining to D2H because it was 22nd of March. So on 31st March, we have paid some amount of interest on behalf of D2H also. And as far as license fee provisioning is concerned, I think it is much bigger than whatever we are discussing. For the quarter, I think it was around 55 to 60 crore.
Right. So 55 crore is just provisioning and the balance is actual outgo.
Okay.
Have you already refinanced some of the Videocon DTH debt on the synergies that you're talking about is already captured here, or that is something we'll see in FY 2019?
Around 75% of the loan is already replaced with the low-cost loan, and balance 25 will be done before 30th of June.
Oh, understood. So it's already reflected in the number.
Yeah, it will.
Now, is there going to be, have you had a proper look at the depreciation accounting of Videocon DTH and for the full year FY18 and for Q4? So Dish TV is to follow accelerated depreciation, and which used to happen. So has that also been taken care of for Videocon DTH, or can the depreciation run rate go up next year if there is any?
Now both the brand are on 5-year period as against 7 years for D2H. That is the change that we have done in the fourth quarter, and it will continue for the next 5 years.
Okay, both the brands are on 5 years now. And the accelerated write-offs that you used to do is also done for Videocon DTH?
Accelerated depreciation is a test which is conducted by the auditor on a case-to-case basis. But now we have enough depreciation in the net block, so we don't need an accelerated depreciation every quarter.
Right. Final one, what should we build as tax rate because, going forward, effective tax rate?
You see, as far as tax is concerned, we will have a long period of tax holiday because of the goodwill generated out of the transaction. So at least for next 4 or 5 years, we don't see any tax payout because we will have the garb of goodwill amortization at least over a period of next 5 years.
But on the P&L also, effective tax rate will be nil, or P&L will still show some tax rate?
P&L will show some tax rate because of MAT provision, but that will also be very small because goodwill amortization will also take place in the company's, as per the company's books also, which is a huge sum.
No, but if you are mentioning MAT, then it will be like 20% effective tax rate of PBT?
Maybe 20%, but the amount or the quantum will be very small because the amount which is subject to MAT will be very small.
Understood.
So there is a huge flow of goodwill which needs to be amortized over a period of 5 years.
Right.
Or maybe longer.
One more, if I may. The synergies that you're mentioning, so is it going to be sort of, should we expect some benefits in terms of lower content cost starting first quarter, or it will be back-ended?
It will go throughout the year. May not be the entire flow in the first quarter, but yes, a major part of it will be resembled in third and fourth quarter.
Right.
I can say, this is Jawahar here.
Yes,
I can say the broadcaster has recognized the combined entity, and then earlier we used to give 7, 8, 5% increase, so this is not the case. Rather, in some of the cases, we had reduced the content cost. And some agreements are still pending. So
are the agreements closure also a function of this tariff order? So do you think if the tariff order things get resolved and if there is no further litigation, then do you expect to close the agreements a little bit sooner?
Well, that's why we had the contract, which is a short-lived contract for 3-4 months. So this is what we had kept in mind, keeping in mind this new tariff order.
Understood. Thank you so much. All the best. And
Thank you. A reminder to the participants to please limit your questions up to 1. We have several participants waiting in the queue. We move to the next question from the line of Rohit Dukania from IDFC Securities. Please go ahead.
Yeah, hi, good evening, gentlemen. Thank you for the opportunity. Just 2 quick questions from my side. One is, can you talk about the reason for the sequential fall in subscription revenue? And second, if you can give some indication of, how the full year sort of revenue and EBITDA should look like in FY19 for the combined entity. Thank you.
Yeah, yes, last quarter has seen some fall in subscription revenue, and I think there are a couple of reasons for it. One, I spoke about our focus on quality versus quantity, which we've started in full earnest last quarter. Second is the fact that this quarter is 2 days shorter than the previous quarter, that both the platforms put together is about 40 crore lower. If you see the difference of the 2 quarters, it's about 95 crores. And about 40 crore can be accounted for because the quote is lower. And thirdly, I will say that, the merger ran into some amount of uncertainty in the last quarter, and that has taken a bit of toll on that. But going forward, which is your second question, we do feel that we should be able to, pick our revenue growth from here. While last year our combined platform growth is about 3%, we are looking at about a 7 to 8% kind of revenue growth in the coming fiscal.
Okay, and so any sort of guidance on the EBITDA side, please?
So on EBITDA, last year it is 31.5%. We're looking at taking that up to 34 to 35% in this fiscal.
For the full year FY19?
That's right.
Okay, great. So just one sort of bookkeeping question. Can you disclose the ARPU on a pro forma basis for the combined entity for FY18? For the full year, that is?
I think we have to recalculate. So let us be firm with whatever we have disclosed, that is 20.
No problem, sir. No problem. Thanks a lot and wish you all the best.
Thank you. Next question is from the line of Avinash Kumar from Moon Capital. Please go ahead.
Yeah, just one question from my side. I mean, earlier you said on the call that post the tariff order, the content cost will not become a complete pass-through. So can you provide a bit more color on it? I mean, content cost saving was one of the major benefits we expected from the tri-order. And a similar follow-up question would be, do you see any execution challenges in the implementation of the tariff order? I mean, on the ground implementation. I know there's some further legal window open, so the case can go to Supreme Court. But apart from the legal lessons, do you see any other execution challenges for the on-ground implementation of this tri-order?
See, as the order stands today, we can keep 35% commission, 20 plus 15, from the price which is charged by the broadcaster. Now, it depends on us how much of that 35% is passed on to the consumer. That is a discretion available to the DQ. Now, like when MD was detailing about the modus operandi of content was, he was keeping this commission factor into the mind.
Okay. Okay, that's fair enough. And can the second part of the question was, do you see any further execution challenges for this tariff order to see the light of the day? I mean, keeping aside the legal hassles, because there is a window open for the case to go to Supreme Court. Keeping aside the legal hassles, do you see any, execution challenges for the DPO industry to completely come in terms with this new tariff order?
No. Like I said, we have already done a replica of trial run for the tariff order, like Mera Wala Pack or Mera Apna Pack. It is in operation since last 3 to 6 months. So we already have a flavor of how it is going to take shape and how to handle the call center, SMS services, and consumer-related grievances. So we can have a firm start moment it is implemented.
Okay, so you feel, you are completely prepared as backend to take this up as soon as the legal hassles gets cleared?
Yeah, more or less we are ready.
Okay, that's all from my side. Thank you.
Thank you. Next question is from the line of Alankar Garude from Macquarie. Please go ahead.
Hi, sir. Thank you for the opportunity. So firstly, you highlighted down trading has been happening for the past couple of years. And now with phase 4, this trend can perhaps intensify going forward. And on the other hand, you also mentioned about improving quality of subs as well as increasing high-definition penetration. So keeping these two factors in mind, how should we look at this ARPU of 201 going forward?
Yeah, so both are realities, in terms of down trading which has been happening over the last 2 years, and we are trying to salvage, something out of that through our various initiatives like high definition and other things I spoke about, focusing on quality, selling more add-on packs, and so on. So this ARPU of 201, I will say that in last quarter, while you are seeing revenue, and we discussed it's 95 crore less than the previous quarter, and we discussed the reasons thereof. But clearly we've had a slight lift up in our ARPU in this quarter, because if you were to look at the ARPUs of the two platforms earlier on as shared by them in the first 3 quarters, you can see that there is some underlying improvement in ARPU, which has Mr. Dalmia said sometime back, we are not getting into right now platform-wise ARPUs. But certainly going forward with the revenue guidance that we spoke about, 7 to 8%, with the EBITDA guidance that we spoke about, 34 to 35%, we definitely hope this ARPU to be moving up. Unlike last year where we saw that for a good part of the year, on both the platforms, it has been fairly static. Our plans are building an increase in ARPU as we go forward.
Understood, sir. Sir, and secondly, on the net subscriber base, now adjusted for the other factors which Dalmia ji mentioned, so how much of this drop from 30 million to 23 million is purely because of the change in the churn policy?
Yeah, it was 6.5 million because of the churn policy, and around 0.5 million was because of complimentary demo and first-time acquired lifetime customers.
Understood, sir. And maybe a small follow-up to that. In the overall business, now that the merger has been completed, have we seen any write-offs coming through at Videocon end?
It has already been factored into in the fourth quarter. That is the quarter which we are discussing.
And can you quantify the amount, sir?
No, it was not like that. There were petty expenses or maybe some distributor accounts, but nothing substantial.
Understood, sir. Okay. Great. Thanks and all the best, sir.
Thank you. The next question is from the line of Naval Seth from MK Global. Please go ahead.
Yeah, thanks a lot for the opportunity, sir. One question, was there any impact on account of change in our churn policy as subscriber number has fallen? Because in the past, whenever subscribers were past due the 120 days, they were written off or say inactive beyond 500 days, they were written off through P&L. And there used to be, one-off expenses in our admin expenses. So with this change in policy, any impact in 4Q numbers?
No, it has not been depreciated or the accelerated depreciation has taken place because of the reduction in the number of contributions. We already have enough depreciation in the book because of only 5-year size for box size.
Apart from, sir, depreciation, there used to be some expense in the, in the OPEX as well. So,
no, it was CWIP write-off, which is not required these days because of the automated system introduced for tracking of the set-top boxes.
CWIP would be the inventory which was not approved.
It was CWIP from set-top box, which was not traceable or which was not used within first 3 years of issue by the company to the distributor. CWIP. That was written off before 2016. But that is not required now because we have a system in place which is tracking each and every box wherever it is located.
Okay. Thank you so much.
Thank you. The next question is from the line of Vikash Mantri from ICICI Securities. Please go ahead.
Thank you for the opportunity, sir. Do we have any content deals which are on a per subscriber basis?
Hello? With one broadcaster out of South.
So, sir, when we restate our subscribers from 29 odd million to 23 million, do we get a huge benefit of content because of that itself?
Oh, that is based on the how many subscribers consume the content, and that is counted on monthly basis. So that will not have an impact.
Okay, fair enough. Also, sir, these 6 million subscribers that were written off, were they largely from the Dish TV brand because the average ARPU has trended closer towards Videocon? I'm asking this question.
Around 3 million plus was from the D2H brand, 2.5 million was from this brand, and 0.5 million was from both the brands as complimentary demo and lifetime subscribers.
Okay. On the license fee question where we said we are going to use the same policies, sir, my question here is effective license fee of Videocon comes to close to 6% and 5.5% to 6%, and ours also comes at the same range because we first have revenues in Dish Infra on which we don't pay. So next year, if we use the same policy, it will not give us any benefit is what I wanted to say. Earlier question, you said there will be some benefit.
So, the treatment was totally different. They were not recognizing it and putting it in contingent liability. Now, by virtue of creation of this infra, it will not be provided for. So there is a difference. And of course, there will be change in the recognition because whatever is there in Dish TV will be provided for and paid for, and whatever is there in the infra will not be paid for.
Yeah, but on as a percentage of consolidated revenues, both pay around 6%.
That may be an outcome, but it can be 4% also or 7% also. Basis the revenue recognition is Dish TV and the tariff and the TV set order basis which we are paying the final license fee.
Okay, and okay, fair enough, sir. On the depreciation, I see that you have said you have moved to both for 5 years, but if I look at your Q3 numbers of both, the depreciation is actually the same. So Videocon reported close to 184 crores of depreciation.
You are right. Like we said, we only added 0.2 million in the fourth quarter. So the overall activation numbers were less in fourth quarter. Plus it is on a revolving basis. Some of the depreciation has already been exhausted, means it has passed 5-year period.
No, sir, when we would have changed the accounting policy of Videocon from 7 to 5, then there would have been a lumpy depreciation recording.
Yes, some of it is dealt in the working of purchase price allocation, and some of it is recognized in the books of account. And from first quarter, it will be regularized. That is the current quarter.
So it will be higher from the run rate that we are seeing right now?
Yeah, slightly higher.
Okay. And, sir, are we going to give a breakup of cost of goods going forward to understand the synergy benefits better going forward, or there will be just this line of reporting that we have shared in this quarter?
No, beyond whatever we have reported this quarter, it is difficult to give details. Maybe on a one basis, when we meet with analysts, we can provide some details.
Okay. And sir, as per the new Ind AS 115 you mentioned, activation income has to be over 5 years the life of the subscriber, like we used to do earlier in Dish?
Yeah, but the life of the subscriber will be determined by the auditor based on past data. So he is working on it. But there will be one element of cost which is consumed instantly. That will be recognized as upfront revenue. Balance will be apportioned over the life of the customer.
What is the policy of Videocon as of now in terms of accounting for lease rental?
1/3 of lease rental they are providing for 7 years, and 1/3 they are providing instantly, and 1/3 is passed to dealer distribution commission from the top itself.
Okay, okay. Fair enough, sir. Thank you. We'll reach out more for details, sir. We need to do a lot of working to understand these new numbers.
Thank you. Thank you.
Thank you. The next question is from the line of Amit Kumar from Investec. Please go ahead.
Yeah, thank you so much for the opportunity, sir. Just wanted to understand, you have mentioned a 60 crore, exceptional cost in this particular, quarter on account of the merger. But when I look at, on a YOY basis, we can't compare, because of the merger itself. But when I look at on a QOQ basis, your overall cost has gone up by only 10 crores. If you can just help me understand, exactly where is this cost, getting booked? And second, what is the nature of, this cost as well?
The total one-off for the year was 84 crores, out of which 24 was booked in the previous 2 quarters, and 60 was provided in the fourth quarter. And this is the stamp duty paid to the Maharashtra government and fees paid to the consultant. Why there is only 10 crore increase in the fourth quarter? Because there was no forex loss booked in the fourth quarter, which was around 26 crore in the third quarter. And also legal and professional expenses, which are usual, was less, and relating to merger was high.
Okay, and this stamp duty paid, exactly which line item, is this coming into?
It will be in administration.
Sorry?
Administration expenses.
All right. All right, understood. That's it from my end. Thank you.
Thank you. The next question is from the line of Ajay Doshi from Kotak Securities. Please go ahead.
Hi, thank you so much again. So just, trying to do some numbers. So you indicated as a guidance that you are, expecting about 8% odd growth in revenues, which effectively means about 500 crores of additional revenues for the next year. And the other number that you indicated was CAPEX guidance of 1,200 crores, which I believe would be about 4.5 million set-up boxes. So if I go ahead with a 10% churn rate, ballpark you're targeting about 2 million net additions, or maybe a little lower than that. So roughly 10% subscriber growth and 8% revenue growth. So is my understanding correct that right now you are not assuming any growth in ARPU for FY 2019 as a base case?
8% growth is resultant of whatever we have able to visualize so far, because previous year it was only 2.8 to 3%. Now, because we have just changed the ARPU definition from 120 days to 60 days, so we really need to work that what will be the impact on ARPU, how much it is going to go up if the revenue is going to go up by 8%. Now, in terms of, have we said that subscribers will move by 10%? No. Subscribers...
So 1,200 crore capex, I'm just back calculating.
No, capex is on gross subs.
Yeah.
So of net subs. So we are only saying the net subs will go up by 1.3 million.
Okay, sorry, I may have missed that number.
So
in that case, the churn rate that you may be expecting would be higher.
Not really, because the gross installation will be over 4 million, whereas the net will be only 1.3. Hence, the ARPU will move only by net and not by gross.
Right, so 2.7 million is the churn. 2.7 million is the churn that can possibly something.
So churn we have assumed 0.8 to 0.9 per month. If you do this math, it will be right.
Right. Okay. And the second question is, 34 to 35% EBITDA margins. If I go with 34.5, that means incremental EBITDA of 350 crores. Now, your synergy guidance of 510 crores probably captures about 110 crores of capex synergy, 75 crores of interest cost synergy. So EBITDA synergy that you are guiding is 325 crore and your EBITDA margin guidance ballpark indicates about 350 crore incremental. So does it mean that again on organic basis EBITDA growth will be very small, or that synergy number that you indicate also captures the organic EBITDA growth?
I think latter is the more appropriate phenomenon. That if we have said 34-35%, it includes the synergy benefits, but it also includes some of the organic benefits that will accrue because of the size of the company.
Understood, sir. Thank you so much for clarification.
Thank you. We take the last question from the line of Vivekananda Subaraman from Ambit Capital. Please go ahead.
Hi, thanks for the follow-up. Two questions. One, any updates from the government on the on our new license and the possible settlement of the regulatory dues? Secondly, what is the government thinking on DD Free Dish? What are your discussions indicating there? Thanks.
I think there was another satellite ATS platform which has been shut down. That was a free dish kind of a platform. On Prasar Bharati free dish, I don't think there is a decision yet. We are expecting a new secretary to join on 1st of June. Then he will take up all the issues and we have to wait. There is no news so far. License renewal is also one of the issues which will be tackled as a first hand by the new secretary.
All right, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I now hand the conference over to Tarun Nanda for his closing comments. Over to you, sir.
Thank you, ladies and gentlemen, and we soon will be talking to you again at the end of the first quarter. The transcript would be uploaded on the website www.dishtv.in, and look forward to talk to you again. Thank you and have a good day.